Hello and welcome to another episode of Monday Markets. As always, we are brought to you by Woo, links available in the description below. As you can tell from my voice, I'm once again sick. There's clearly some sort of turbo COVID going around in London, and I can't help myself from licking all these toilet seats. So I've got it. Hopefully you can bear with me during the course of this episode. So before we do the TA stuff, I wanted to do an overview of futures and kind of do a market health check at a glance. This is something I do at the start of every trading day, so I thought it might be helpful. If it isn't, let me know. If you want me to do the TA stuff, I can do that. If you find this interesting, also let me know. And this show is for you at the end of the day, so make your voice heard. The first thing I'll check is the 3-month annualized basis. So this is essentially the premium that's baked into the Bitcoin quarterly futures. So perps, they don't have an expiry date. That's why they're perpetuals, whereas quarterly futures do, and they roll into the next contract. And essentially, when you have perps, you have a spot price, right? Or a spot index / index, which is just the spot price of BTC, or a basket of spot BTC instruments. And on the other side, you will have the perp, which is the future, or the quarterly, right? We'll just call that Q. Now, for perps, the way it works is, if the perp is trading at a premium to the index, which is to say above it, then the funding rate will be positive. And that means if you're long, you have to pay to be long. And if you're short, you receive the funding rate. The idea there is to encourage people to buy spot and sell the future, or just sell the future in general. That's not how most people structure that trade. And the idea is by selling the perp, they can push down the gap between these two and have these instruments trade closer in line with each other. And it works the other way around as well. If the perp price is below the spot price and trading at a discount to the index, then funding will be negative and you're incentivized to long because you will receive the funding rate, and you're disincentivized from shorting because you'll have to pay the funding rate. And obviously the more out of whack these two things get, the higher and or lower the funding rate will be. So the best way to think about it is a sort of incentive mechanism to keep the perp price as close as possible to the underlying index price. So perps are intended to be a kind of highly leveraged, easy to use spot mimic. And the way these instruments trade somewhat in line with each other, or at least the way the incentives are set up, is via the funding rate. But in more traditional futures or in quarterly futures, there is an expiry to these contracts. They roll, and typically the difference between the spot price and the quarterly future is called the basis. And so when we're looking at this 3-month annualized basis, 3-month just refers to the duration of the contract before it rolls into the next one, and annualized means whatever the difference is between the current BTC price and the contract that is 3 months in front, that's extrapolated to 1 year. So it's essentially another way of looking at premiums in the market. You could look at perp funding rates, or you could look at quarterly basis and quarterly basis annualized. Another way that some industry participants look at this rate, they see it as a sort of risk-free rate in crypto. I don't think it's necessarily risk-free, because obviously there's a borrow component to buy spot and sell the future if you want to capture this in a sort of delta neutral way. But nonetheless, because you can do this trade in quite a bit of size of just buying spot, selling future, these are very liquid markets, typically very well collateralized, so on and so forth, and the borrow costs aren't particularly high. Because it's a very sort of scalable, accessible trade, in some circles it's seen as the sort of risk-free rate in crypto. For example, why are you trading perps, slugging it back and forth, if you're underperforming whatever you can get for buying spot and selling the future? So looking at this, it's in a pretty reasonable spot, around 10% on OKX. It's the highest venue. Binance and Deribit are about at 9%. It's been creeping up a little bit, but mostly still at a healthy spot. You'll recall the last time we spoke about it was here when it was around 20%, and that was rather confusing to me. It pretty much doubled, or went from sort of 12%, 10-12% all the way to 20% without the market moving, and I argued at the time on Monday Market, so that's an indication of just a lot of premium and a lot of leverage without any follow through in the underlying, which is a bit frothy. In this instance, ever since it came down, it's stayed more or less around the same levels. The only reason, or the only instance in which this would become concerning, would be if it again starts to just ramp up disproportionate to the moves in spot price. But just in general, as long as this stays somewhat in tune with spot and doesn't sort of go off and veer on a mind of it in a sort of direction of its own, I think it's pretty reasonable at the moment and nothing too concerning there. and we can look at it. You can see how outlandish that 20% spike was. It's going to come back and stabilize at more reasonable levels. I don't think you can view this in a vacuum, as in, okay, well, 8% is healthy and 12% is unhealthy and so on and so forth. It depends what the underlying asset is doing. But in general, when you see a divergence between either the funding rate, if you're looking at perps, or basis, if you're looking at quarterlies, a divergence between whatever that number is, that premium, and the spot market, that's when things get a bit disconnected and dodgy. But for the time being, I think it's fine relative to price action. The other thing that I like to look at, if we go over to the the market tab, this is quite nice for just getting an overview of the biggest price changes based on large caps, mid caps, top gainers, top losers, lets you filter stuff. As someone who doesn't super actively trade altcoins, but I like to look at the outlier stuff and get a sense of the market, I will just literally click on Binance or Bybit or OKX, usually Bybit or OKX, and see where the highest, and I'll filter from high to low to see how many altcoins have particularly high funding rates or high relative to the baseline. And at the moment, there's really nothing particularly frothy or crazy going on that front. You can see the Bybit is completely sort of neutral or in line. It's pretty average. You know, the sort of baseline funding rate is 0.01%, so nothing going on there. There are a few slightly hotter ones on OKX, but again, it's hardly market wide, and these aren't out of reach by that much. There's nothing really crazy or peculiar going on. So in terms of market positioning and sort of froth levels, leverage, all that type of stuff, it's fairly reasonable, right? So if we look at the futures tab, we know that quarterlies are fine. There's nothing scary going on there. If we look at the market as a whole and look at altcoins, Bybit is entirely in line. There are a couple of hot ones on OKX, but nothing too crazy. So from a positioning point of view, there's nothing particularly scary going on, in my opinion. The final thing I will periodically look at, and I know it lags slightly and the data is updated every 24 hours, I think, is I will look at other venues like the CME. We can see that premium got unwound quite a bit, traded at a low of 5%. It's at 7% now, so again, even lower than crypto native venues, and I expect this never to really ramp up that high again now that we have the ETFs. But just in general, I think we've seen the most of the unwinding leg in this instrument also. So all across the board, as far as leverage, froth type indicators, nothing too crazy. We could look at Coinalyze and look at aggregated open interest and that type of stuff, but I'd be very surprised if it shows a diverging picture. So that is what makes sense to me from positioning point of view. Now, as far as technicals, we have 2 days left until the monthly close. The monthly close should be kind of neutral, I think. We've had some good month-end price action, but bigger picture, the important level that sort of trading where we are right now is 44 to 47k. Again, going back to this monthly range midpoint, and looks like we're going to close below it, or at least into the level. So if you're looking at this from a sort of spot investor higher time frame point of view, your general mandate is to allocate on dips / consolidations into support, and this isn't one of them. So even from a shorter term trading point of view, if you were looking for a multi-time frame continuation type of trade, that would have to be through 47 plus. And at that point, your argument is that we kind of soft rejected from the midpoint, but broke above it, and then the next reasonable target is the range high at 58 and 60. I think that's fine. I think alternatively, if this ends up being the period where we consolidate and then dip into monthly support at 35, 37, that would be a good area to trade simply based on the proximity and validation. That makes sense to me. But trading under 44, 47 from that high time frame perspective is, I think, the worst option out of all of those. Strength through the mid-range is better because you have a very clear target on the other side of it. A dip with something risk defined or into a key area, 35, 37 being the key monthly one, is better, but a sort of really wicky close into the mid 40s, I think, is far less clear than either of those options. So if you're looking for monthly time frame, multi-month spot type of trading, I think more weighting is on the menu. The weekly time frame is probably one of the more interesting ones. Interestingly enough, for as long as all the price action that we've had post ETF, structurally we've had no changes whatsoever. Now that sounds a bit unreasonable, but if we look at this from a highest close to lowest close point of view, and that's not even looking at the wicks, right? Just the closes alone, we've been in the same range between 41 and 44k for 1, 2, 3, 4, 5, 6, 7 weeks now. So almost 2 months of quite literal range-bound price action, and that's being conservative by using the candle bodies and not the wicks. At this point, I would also be willing to argue that we've had sort of failed break attempts on both sides. We had a very tall wick to the upside, which didn't lead to continuation, and now we've had a very tall wick to the downside that didn't lead to continuation either, and we're still within the same consolidation. Now that both sides have been sufficiently faked out, I think that taking the next weekly close at face value is not the worst option, which is to say that if the weekly closes through 44k, then that's a valid weekly breakout. If it closes below 41k, that's a valid weekly breakdown. I think the odds of those turning into a failed breakout or failed breakdown are significantly lower because we've kind of had at least some version of that with how far the market sort of violated those range boundaries but still closed within them. So if you're looking for more systematic type of signals for multi-week type of momentum entries, I think the weekly time frame is your friend, and it's somewhat bolstered by the fact that we've already poked both sides quite significantly. So if you're high time frame oriented, then I think we're in an area where, especially after this long period of consolidation, the next move is more likely to be trending than not, and I think that the next weekly close through one of these boundaries will be more likely to be signal than a second fake out. That is, and also necessarily because we're here, the weekly time frame is neutral to bullish. The neutral side comes from the fact that it's just sideways, and we've had a failed break to the upside and to the downside. The neutral to bullish argument is that this consolidation is contextualized by a preceding move higher. So in general, when you have an impulse and consolidation, continuation in the direction of the preceding move is generally higher probability than reversal. So impulse, consolidate, impulse in the same direction is generally higher probability than impulse, consolidate, reversal. That's not some law of nature or physics, but that's a sort of helpful starting point, and then you assess evidence to the contrary. You can think of it as a sort of rebuttable presumption. The daily time frame looks good. I think out of the higher timeframes that we like to follow on this channel, at the moment, it's the best looking one. The argument there is essentially that we had a failed breakdown at 41k. So we closed through it on the 22nd of January, had this bit of price action here that didn't go anywhere, and then a strong reclaim. That's good. The other side of that range is at 44k, which also happens to align with that weekly range high. You know, if we just flick over, we can see that it's more or less the same level. So if you get a weekly close through 44k, that starts to line up a few things. You have a weekly breakout and a daily breakout after a failed break to the downside. Now, that's what makes sense on the daily. Necessarily, when you're dealing with these types of structures, you still have to be slightly careful because both sides have sort of been faked out previously. You know, this is the upside break that we saw on the weekly, seen on the daily. This is the downside break we saw on the weekly, seen on the daily. If the market is bearish, bears were way too early on the selling the retest of 41k. As Don and I have talked about, these bearish retest types of patterns in crypto just don't tend to work very well when you have a really clearly established range low, multiple touches, breaks, and then comes back to retest it, especially if it does it so soon, you know, 3-4 days after the fact. These retests don't tend to hold, and they tend to squeeze up, even if ultimately they result in lower prices. So the area that's most risky for that, I think, is necessarily the range high, or around 44 to 45k. So whether you want to take this highest close here or just box out this entire candle if it suits you, I think if we're going to get rugged anywhere, the most probable lower high area is 44 to 44.5-ish. Now, given how the market is positioned and the absence of super froth, super leverage, this would have to be just a sort of purely technical setup. There isn't a lot to suggest that, look, we're coming into a potential lower high area and it's frothy and you should definitely sell it. This will have to be a very sort of short-term trading determination, if anything. And also bear in mind that if you get, you know, if you're wrong, like you sell this and you're wrong, and suddenly the weekly and daily timeframes fire off a breakout, there's at least some chance that shit just really accelerates without you, and you miss out on the bigger move because you were focused on the short-term trading move at 44, 45k. So there are some costs associated with that. It's still resistance. If you wanted to be super mercenary technical about it, then you just essentially trade the consolidation, you know, 41.2 support, 44, 44.5 resistance, and that's it. But I think the higher time frame context is slightly more important on this occasion, and for me personally, I'd rather give more weight to the weekly signals and wait for those rather than fool around too much with daily time frame stuff. I think even if you wanted to be really bearish, from a sell the rally point of view, 44.5 is your best / only bet, because we know that's the daily range high and the weekly range high. So it's kind of, X marks the spot. But really, if you're looking for that type of setup, I think now that we've had a failed break in either direction, it might be worth waiting for sub 41k to get a higher probability bearish setup. Yes, 44.5 is technically the better entry, but even then, from a trade management perspective, you'd technically be looking to cover that around the range low, right? If you're going to be technical about it, if you're selling the range high, your first trouble area or take profit in some sense is the range low. Whereas if you're waiting for sub 44, then your signal isn't just some sort of, range to range trigger, but rather the setup is a weekly plus daily momentum trigger, and this would be a failed reclaim if the market loses 41k, and then you could justify bigger targets on that, I think, at least to the previous breakout levels at around 37, and then maybe we get the higher time frame 34 to 37 monthly, weekly, daily, etc. So I think if you want to be a bear, purely technically, 44.5, sure, that makes technical sense. If we're talking bigger signals, more conviction at the cost of a worse entry, sub 41k, I think, is on balance better, depending on how you want to trade it. I think the daily time frame also just reiterates the argument that was made on the weekly. We've had a big fake out up, we've had a big fake out down. I really think the next move that violates these boundaries is much more likely to be real than not. And I also think the move that will come as a result will be bigger, because we'll then view this entire thing as a long consolidation before the impulse. I think that impulse is much more important to get right from a trading point of view, and it will pay better than getting the next rotation within this range correct, So hopefully that makes sense. I know it was a bit rambly, but that's how I'm viewing these things at the very least. And on the ETH front, before my voice disappears completely, I've seen some arguments that this could potentially be a bailout spot as far as Ethereum demand. I'm not sure how to pronounce that word. I'm sorry, English is very difficult. I don't know, and I'm not sure. So my suspicion is that given the strength of this weekly downtrend, and given the failure to reclaim 057, this is just not an interesting chart. So looking for allies in ETH BTC, I'm personally, I don't have a lot of time for this. If I were to be interested, it would have to be, again, another well, at this point, it might as well just make a higher high, right? So you have this sort of excursion through 057 that didn't lead to anything. So you might as well raise the bar a little bit and look at this level that Don mentioned at 06 that got retested as a sort of maybe supply zone type of thing. Doesn't really matter. Just from a market structure point of view, we can look at this as some sort of high, and then this ended up being a lower high. If we get a market structure break above 06, that would both give us a market structure break for a change. We haven't had one of those in ages. And it would also necessarily result in a reclaim of 055, 057, or whatever. So at that point, you've got local market structure break and range low reclaim on your side, as opposed to just chasing this momentum candle, and you've given back half your gains, even if you bought the bottom. So no sort of respite in ETH BTC quite yet. On the ETH USD front, I think the market bounced from a very logical technical spot that we wrote about on Technical Roundup newsletter, trletter.com, which is this weekly lowest close. But given the ETH BTC weakness, I'm still not terribly interested in this. It could trade, I mean, sometimes when ETH is boring, it trades quite well technically. It's just, it never really lives up to expectations. If you're in that camp and you're fine with it, then I think the relevant levels are something of this nature, between 2200 and 2350, maybe 2400. But, realistically, this is a 8% range from one extreme to another. Definitely tradable, but I think there are probably better opportunities and better assets to trade in this market. But hey, if you like those quiet spots in the market that doesn't surprise you, but does the basics well, then I think regardless of the time frame, be it the daily or the 4-hour, more or less this ETH range is fairly well defined. So do with that what you will. But as far as multi-week type of outperformance, I'm not seeing a lot of evidence for it, neither in ETH BTC nor ETH USD. And I will just quickly cover Sol. There's a lot of narrative speculation based on the Jupiter token, airdrop, and the ecosystem as a whole is still the home of meme coins and has a lot of attention. Solana itself has been quiet for a while. It had this sort of downwards drift, nothing too volatile, but if you measure from high to low, this kind of drawdown or pullback sneaks up on you. So it's been sort of bumpy, but very clearly downtrendy. So you can sort of miss it if you're not paying close attention. But from high to low, this is a 37% pullback. That's quite big. It's a fairly sizable correction. It didn't hit any of the obvious high time frame levels, at least on the daily. The pre-breakout area was closer to 74, and that's the same on the weekly as well. You can even be super charitable and use this lowest close here, and that maybe just about got hit depending on the exchange. But in any case, I think because this market was downtrendy and so boring for a while, people kind of lost interest, at least on the main asset itself, even if the ecosystem was very much on the forefront of speculation. But sometimes these outperformers can go through periods where they're a bit slower and people forget about them, and then they just surprise to the upside and you're like, oh shit, that Solana thing, it went up like 1,000,000% and I missed it, and then it went down 40%, but because it was so slow and boring I didn't touch it. Those trades do happen, and I think this is at least worth having on your radar for that reason. If this thing accelerates, then the way it's been trading, it should be like a very straightforward, almost meme-y trendline break and continuation. I don't know if there's a super appropriate way to draw this or curve fit this, which is how most trendline drawings go, but same with horizontals. I'm not, don't mean to start a gang war here. But realistically, if this is going to be one of those patterns where you have a strong outperformer, then it becomes boring, okay, I guess it's downtrending, whatever, maybe there's a new coin, and then it does this, and you're like, oh my god, why didn't I buy here? If this is going to be one of those patterns, then it should just really get going and rip the face off anyone who thinks, oh, well, we're at the range high here, or, there are equal highs, whatever. If this is going to be a momentum continuation to the tune of outperformance, then it should just go from here. Reclaim 100, psychological round number, and then go. Now, setup-wise, that doesn't make it very easy. If you're swinging it, then sort of below the trend line is probably a decent invalidation. Then you're targeting sort of a larger time frame breakout. If you want to get more technical about it, then the minimum on the daily time frame for this to shift to bullish market structure or reverse the downtrend is making a higher high. So if you look at this, you've got high, low, lower high, lower low, lower high, slightly higher low, lower high, lower low, and so you'd want to see a higher high to break that market structure, and the closest and the most reasonable area for that is above 102. So if that breaks, obviously you're later to the entry, and maybe it pulls back to make a higher low and stops you out in the process, but that would be the daily shift from this somewhat slow and boring trend that we've had, and then at that point you might as well target towards the old highs if this is going to resolve to the upside and be trend reversing. But just in general, I wanted to flag this as a potential trend line meme play, flag the 100, 102 level as an important market structure thing, and I think at the very least, if you're punting high cap, liquid, layer ones, this structurally makes more sense than Ethereum for the time being. That's really all I've got, and more importantly, those are the limits of my voice box for the time being. Thank you for bearing with me as I sound like, I don't even know what I sound like. I'm sure you can come up with something creative in the comments. Hope this is helpful. If you want me to keep the futures segment or do some more educational stuff, if you have specific questions, let me know. I can try my best to answer them at the start of a future episode. Otherwise, thank you to Woo for supporting the show. Be sure to check them out via the links in the description below. Hope you all had a wonderful weekend, better than mine at least. That shouldn't be hard. I was in bed dying. Have a wonderful week, and I'll see you for newsletter, Don stream, Casual Friday, all that good stuff. Thank you. Bye-bye.